I've often thought what would happen is continuing claims would be the problem, but I didn't think that would show up until 2026, and then we would start a series of rate cuts. It's here. We are at peak continuing claims. We are at peak people falling off, which means they've exhausted their benefits. So I think the job market is perhaps the worst I've seen since the GFC.
All right, I've got Mr. Mike Zuber, the guy who said we would get no Fed rate cuts in 2025. It seems like the tune has changed. I thought I even heard something about a 50 basis point cut. So you got some splaining to do, buddy. What has changed in your world to make you, change course on the no cuts in 2025 call that you once had?
Yeah, I appreciate that. And you're the first one to really put my feet to the fire. So I appreciate you following and kind of having me kind of pull this together. So for the longest time, I believed that in 2025, we would have no rate cuts, right? That was a bold call made in December of 24. And really up until 2 Fridays ago, I was feeling really good about that call. I mean, I was starting to count my winnings. And then you asked, what changed? And you're right. I'm now calling for 50 in September. I mean, I went from doing 0 cuts to 50 in September. So what changed? It's basically the job market. I have often believed that even though the Fed Reserve talks about having a dual mandate, I know they can't. I know there's always one priority slightly higher than the other. And I believe we live in a world today where it's labor over inflation. And I think what we learned last Friday is the job market is much weaker, much, much, much weaker than we expect. I've also read articles from Goldman Sachs, JP Morgan, and Bank of America and others that are telling me we're going to have another September adjustment to the jobs number. If you remember last year, we suddenly lost 818,000 jobs, right, in this once a year adjustment. And they're basically saying, this adjustment coming is, could be on that order of magnitude. So again, the job market's much weaker. Then I go back and I've been studying economics for 30 years and where government data really goes wrong? It's at inflection points, right? When we're just trending along, government data is not horrible. Where government data goes wonky and goes off by 3, 4, 5 standard deviations is at market turns. And I think it's very clear that the market has turned and the government data missed it. You can't go from 2 months in a row of 150,000 jobs created to 25,000. And that's what happened. June and July. Dude, who's going to believe the July number or the August number for July? The August number was horrible at 75. But the previous 2 months had 125,000 negative. So the August number could be negative at the first adjustment. So you asked me what changed. The job market is much weaker. And I can't overemphasize. It's much, much weaker. I've often thought what would happen is continuing claims would be the problem, but I didn't think that would show up until 2026, and then we would start a series of rate cuts. It's here. We are at peak continuing claims. We are at peak people falling off, which means they've exhausted their benefits. So I think the job market is perhaps the worst I've seen since the GFC. And it's hard to say that with an unemployment rate of 4.2%. Again, the reason I changed my tune is because I dug in. The last thing I'll talk about is one of the reasons that the unemployment rate fell from 4.3 to 4.1 is something called the participation rate. And basically what the participation rate tries to highlight is how many people are participating in the job market. And if the participation rate is falling, it artificially keeps the unemployment rate low. So something I did after that horrible Friday's job number is I said, okay, let's assume for a minute that the participation rate was the same as it was in April or May. I forget which month I used. I used either April or May. And the answer is, this is what changed it for me. This is like the one thing. The unemployment rate today would not be 4.2. It would not be 4.5. It would not be 4.7. It would be 4.9%.
Wow.
And I know one thing for certain. if the unemployment rate was acknowledged to be 4.9%, we would get cuts. And the reason I think we're going to get 50 is because they owe us September, but they also will acknowledge that they fucked up in July, and they will give us that one as well. So that's what I think is coming. That's why I've gone from 0 to 50, because we have a 4.9% unemployment rate, and it's just bad math that has us at 4.2. So there's a lot there.
It'll be interesting to see, right? Because you talk about a makeup, and I've heard it now. It's only been a couple days that people have even thrown out this idea. But if you go to like Fed Watch, it's still
zero.
Zero.
I checked it this morning. 0 for 50. It's coming.
It's a 0.05% chance there's no cut, which is crazy, right? And then there's 99.95% that there's one cut and nothing on 2 cuts. But either way, I agree with you 1,000%. And for me, I honestly don't dig into numbers. I just have conversations every day. And it felt to me like, man, people I talk to are struggling. People are losing their jobs. People are having a harder time finding jobs. This doesn't feel like a super strong job market. And lo and behold, that proves out now once these numbers get revised, and now, we're acknowledging the job market's not as strong as the numbers portrayed or that we talked about. And also I'm with you on, labor, whether they say it or not, being more important than inflation, because 2.7% inflation is not crazy. Like, the funny part is when I look at it sometimes and I hear people talk about it, like 2% is just a made up number, right? Mm-hmm. If we said we're targeting 3% inflation, it would be below that, and so I think. Well,
so the other thing, let's hit inflation, because that's the thing I'm going to get pushback on. How can you do this? You've been telling us about core inflation 3.1, it's going higher, yada. So 2 things. First, I tried to tell everybody this was coming 6 months ago. This was a lock 6 months ago that July and August would show CPI going up because of what's called the base effect. But I want to give credit where credit is due. Danielle DiMartino Booth went in and dug deeper into the data, and 54% of the core increase was shelter. Shelter is another effed up government statistic. There is no chance in hell that rent is going up 6%. It has, in fact, been going down if you use accurate data. So again, one of the reasons that core is up, because once again, the government has garbage data and is saying that shelter is up 6%. And if shelter is 33% of inflation, but it is a bad number, then CPI core is a bad number. It's just like all of these things are compounding. And, I think the Fed has to look through this and realize that the labor market is really, I think I read an article that the labor market is like Wile E. Coyote, right? You're a Gen X guy like me. Remember Wile E. Coyote running off the cliff? Uh-huh. He kind of hung there for a second before gravity. Before gravity kicked in. Yeah. We could be there in the job market. We could be on the cusp of some hard days.
Yeah, and it's tough too, because with the housing, what's the word? I can't. It's not coming to me with the data you just spoke about.
Shelter.
Yeah. We're using lagging data to make today decisions. To your point, another real world example, I'm having conversations about vacancies in units that I own, and I've got all the data look back from 2019 when I bought the place. Never had a harder time renting this place. Is that an environment where rents are increasing 6%? And no, it's not, right? And so in the real world, we're experiencing flat, declining rent, and on these lagging numbers, it's showing shelter up 6% and misrepresenting
the Fed is looking at a rearview mirror. The economy is at a pivot point, inflection point, and this is where they always crash into the tree. They don't realize what's going on below the surface. They're looking at inaccurate, lagging, fraudulent, wrong data in making decisions that are impacting the country. So why do I think there's a 50? And again, to be clear, the Fed Watch tool, the smart money, says I'm a moron. It says there's a 0% chance. But guess what? I am not going to change my opinion. right? It is going to happen, or I'll just admit I'm wrong. Dude, I'm wrong all the time. But I love to learn. And, we still have 5 weeks before the next meeting. And I think the data gets worse from here.
Right. Yeah. And so what I want to talk about now, since we've laid all that groundwork, is what everybody who follows me constantly wants to know. What does this mean for mortgage interest rates? The cool part is it was only a year ago where we got a 50 basis point cut.
True.
And we can look back and say what happened then.
I can tell you what won't happen.
Okay, tell us what
won't happen. So let's just say for a minute, for easy math, on September 17th, which I think is the meeting, mortgage rates are 6.5. And let's just pretend for a moment the Fed does what I say they're going to do and they cut a half. What I can guarantee you won't happen on September 17th or September 18th is mortgage rates will not be 6%. There is no one-to-one correlation between the Fed rate and mortgage rates. In fact, I promise you this much, the market will pre-price in a rate cut. And we saw this last year. In the run up to the 50 basis point cut, mortgage rates came in about 3/8. Then we got a surprise 50, which again shocked the market. The market looked at some recent jobs data and said, holy shit, the Fed was wrong. And mortgage rates went up, not down. So just because I am confident that the Fed will cut, and I'm arguing cut 50, does not mean mortgage rates are going down. I am not making that call.
Right. Yeah. And so that's what people need to remember too, is one, to your point about leading up to the meeting, this is not like all secret talks and we're the only people that know about what the Fed's going to do. Like the market understands that, prices all that. And so 6.375 leading up to the meeting last year, and then all the way down to 6%. And then, it was a terrible jobs report that torpedoed rates and rates went up. And everyone's like, we just cut 50 basis points, rates went up. And good luck trying to explain that as a mortgage broker to somebody. Fed funds rate, mortgage rates went up.
Yeah, I bet that was no fun.
No fun. It's almost as fun as the 7,000 conversations I had when Fed went to zero, and people were like, mortgage rates are zero. Sign me up. I want one of those. No, I had a YouTube video. I had to send to about 300 clients that year. But yeah, it's going to be an interesting time, and so I still think the trend is downward, and I think that that's so 5 or 50 and.
I think again, nobody's crystal ball is, nobody has one. I'm just looking at historically. When I look at the chance, again, let's compare last year's 50 to this year's, what I'm calling 50. I think the economy is in a vastly different place. I think the economy is in a much worse place. I think like I said earlier, labor over inflation. I think there's a general understanding that the government data has been either lying on purpose or just structurally flawed. You can pick whatever side you're on. The data has been bad. That much you can say.
I think they're just stupid.
Or stupid. Yeah, whatever you want. But again, the data is bad, but that bad data has been used to make impactful decisions. And now there's just a general understanding the data sucks and they should look at actuals. And I don't think the picture is very pretty. And I think the Fed is going to wake up and realize that they were wrong about July and that they owe one in September, and bingo bango, you get 50 for a makeup, for a miss. And I'm not going to change my opinion. But now mortgage rates. So mortgage rates today, what, like 6.3 today ish?
6.5, 7, I think.
All right, let's call it 6.5.
Yeah.
So it would not surprise me that through the rest of the year, we don't trend lower. I am not calling for a waterfall or a crash or anything of that nature. I think it's fair to say that, if you assumed rates are 6.5-ish on August 13th, that they could be 6.25 by, November 1st and maybe 6.1 by the end of the year. I think we're still in the sixes, I guess is where I'm going with that. And that is even with the realization that I think the Fed cuts 100. I think the Fed cuts 100 basis points in 25, 50, 25, 25. There's 3 meetings left. So I think, again, the Fed's going to lower 100. I think mortgages fall 30 to 40 basis points. That's kind of where I'm at.
Yeah,
But they could go up. They could go up.
They definitely could go up, and we probably save it for next week because we don't have enough time this week. But the Fannie and Freddie leaving conservatorship, how would that affect rates?
I do not have my opinion on that. Just real quick, we should do a video on it. I don't know how rates don't go up if that happens.
They have to.
They have to, right?
Yeah.
The risk premium have to go up.
Right. Yeah. Yeah. Investors want.
Yeah, they want a return.
They want yield. They're not settling for what it is now. So yeah, there's that. But for rates, what I am advising people to, and it's like we've got some refinance opportunity. UWM's doing this promotion of 90 basis points.
Oh, wow.
Everybody, if you get a little bit of downward, momentum, oh wait, it'll continue to go down. I don't see it coming. And to your point, like,
be very careful.
The 657 or 658 of today, that's really best case scenario. That's really paying a little bit of points. That's having a 25% down payment. That's for the best of folks. And so, it's really probably a little bit higher than that. But call it 6.5 to 6.75 now. Best case scenario, we're like 6.25 to 6.5, and we're in that range in Q4.
Sure. Like, yeah. It's nothing.
Literally no way we're sub 6.
I don't think so.
It can just
I can't
usually stay the same or bump up. And so I'm sticking with that call I made, which was kind of telling people, listen, the market we're in right now is the market you should expect for the next 6 months, for better or for worse.
Yeah, I don't think that's bad. I think that's fair.
For the investors, it's a lot of better. Like I literally said that at a real estate meeting, like it's a great time to be a buyer if you've got the right mindset and the right strategy. So don't wish for things to change.
Yeah.
Wish for it to stay the same, and for sellers to continue to kind of be stuck in the mud.
Yeah, if you're a buyer, I get it. I know this is not the entire country, but I would argue it's 60% of the country, if not slightly more, are in the first buyer's market since 2015. Enjoy it. They don't last long. And this one won't last long either. And then all of you are going to come back to me and go, I missed it again. I'm like, yeah, you missed it again. So it's pretty fun.
Yeah.
Matt, where can people reach out to you?
Go to greatmortgagebroker.com, to that final point where buyers are like, oh, I'm going to wait. I have those conversations every single day. And I promise you, if nothing else from me, you're going to get honest advice. So greatmortgagebroker.com. Let us know where you're at, what you're looking to do. Me and my team will answer questions you have, get you pre-approved with a soft pull. And, it's the first step. Even though people continue to do steps 4, then 2, then 3, then 1. Step 1, figure out the numbers, figure out who qualify. Don't go out and walk through $1 million house and have all these dreams going on in your head when the numbers just don't work and you can't buy it. There's no use in walking through a store full of stuff that you can't buy unless you just like torturing yourself.
There you go. Greatmortgagebroker.com. Thanks, Matt. Take care. Have a good week.
Thanks, Mike. You too.
Bye.